This is Nightly Business Report with Bill Griffith and Sue Herrera.
Doubling down, the U.S. threatens $100 billion more in tariffs while China vows to fight back at all costs. And stocks sink. Winter woes. Nasty weather takes a bite out of the March jobs report. Is it enough to keep the Fed at bay? And was it really as bad as it looked? And Office on the Go, how the busy schedule of two entrepreneurs helped them create a mobile workspace for modern times. All that and much more tonight on Nightly Business Report for this Friday, April the 6th. And we do bid you a good Friday evening, everybody. I'm Bill Griffith. Sue is off this evening. Fears of a trade war, worries over rate hikes, a lackluster jobs report. These three all rattled the investors today on this final trading day of the week, and stocks fell sharply as a result. Here were the final numbers today. When all was said and done, the Dow was down 572 points, back below 24,000. That's its biggest decline in 2 weeks, by the way. The NASDAQ was down by 161. The S&P lost 58. And as you can see, all the major averages were down more than 2%. For the week, the Dow, the NASDAQ, and the S&P were lower as well for the third week in the last four. Bob Pisani has more on the sell-off from the New York Stock Exchange tonight.
Traders are eager to change the conversation from trade wars and tariffs to the economy and earnings, but it's hard to do that when President Trump keeps upping the ante, as he did last night, saying he's exploring an additional $100 billion in tariffs. Traders have been trying to convince themselves that the president's belligerent tone is a negotiating tactic and that ultimately any damage from the trade wars will be modest. But the president seems to be doubling down and less concerned about markets. Treasury Secretary Steve Mnuchin appeared on CNBC midday and acknowledged there was a potential for a trade war, though that was not the intended outcome. Regardless, the markets drooped after that interview. Traders have been eager to give Trump the benefit of the doubt, but that's beginning to fade. The stakes are going up, and there is a rising possibility of a real impact to GDP and the economy. There is considerable collateral damage, with industrials and materials down notably, and traders are now regularly complaining that there is no visibility and the market may be becoming uninvestable. That's a bad word. Okay, what comes next? Thankfully, earnings will start next week, and they will be outstanding, with the best overall earnings growth we've seen in 7 years, about 18% for the S&P 500. Beyond that, traders can only hope that negotiations with China start sooner rather than later. Some are hoping that the president's trade representatives should talk a little bit less, since conflicting voices are clearly causing some confusion. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Now, the White House's new $100 billion tariff threat that Bob mentioned adds to the already heightened tensions between the world's two largest economies. Kayla Tausche following the story for us tonight from Washington.
It started Monday with China hitting back on steel and aluminum tariffs, escalating throughout the week. U.S. and China matching each other's $50 billion tariff threats before President Trump added the potential for another $100 billion. Treasury Secretary Steven Mnuchin said this isn't a trade war yet.
Right now, we've initiated a plan. The tariffs will take some period of time to go into effect. There'll be public comments. So while we're in the period before the tariffs go on, we'll continue to have discussions. But there is the potential of a trade war.
Mnuchin says a trade war is not the objective, but President Trump has been clear with President Xi that he would defend the U.S. interest for free and fair trade. The two leaders, he said, have a great relationship. The two countries still working on a resolution. On the one hand, we absolutely are willing to negotiate and not get into trade wars. But on the other hand, the president is perfectly willing to defend interest. So this is a very clear strategy. But what's clear to markets is that this is far from over. $150 billion represents a third of China's exports to the U.S. Goldman Sachs told clients China could move past tariffs to something more painful, devaluing its currency, selling treasuries, or further limiting U.S. company access. Farmers and manufacturers worry their businesses will suffer while they wait for a deal. Federal Reserve Chair Jay Powell said that could change economic outlook down the road.
We did hear from a number of business leaders around the country that changes in trade policy had become a bit of a risk to the medium-term outlook.
It's hard for observers, including former Commerce Secretary Carlos Gutierrez, to see the end game.
This looks like a poker game. I'll see your 50 and I'll raise you 100. It just seemed like this was just escalating at a pace that no one expected. I don't know how the president will declare victory, which is so important to him because taking on China has been one of his signature issues.
President Trump's economic advisors defend his willingness to take action no prior president has. But in doing so, he's also raised the stakes higher than they've ever been. For Nightly Business Report, I'm Kayla Tausche in Washington.
Meanwhile, reaction from China was strong and it was swift. Eunice Yoon is in Beijing for us.
Secretary Mnuchin might be playing down the idea that the U.S. and China are headed for a trade war, but the Chinese are definitely gearing up for one. The Commerce Ministry today scrambled together a last-minute press briefing to say China is well prepared. If the U.S. releases its new list of $100 billion in products, we will immediately fight back without any hesitation. We won't rule out any option. The ministry also countered talk out of Washington that the two sides are having private discussions about trade, saying China has noticed similar information about negotiations from various American officials, but this is not what has happened. Recently, U.S. and Chinese economic and trade officials haven't had any negotiations on trade issues. The government has been messaging to the public here that China is the victim in all of this, which plays right into the way President Xi Jinping likes to present himself as a defender of China from Western aggression. And the messaging is having an effect. On Chinese social media, two of the top trending hashtags are "Fight Back the Trade War" and "China is Not Afraid." And we're just starting to see online calls for boycotts for American goods. Here are some examples. Boycott American products starting from today. No iPhones and no American cars. After Japanese and Korean, it's time to boycott American goods. Right now, this is just talk on social media, but the government here can and has encouraged boycotts in the past when it's been upset with another country, like Japan or South Korea. It's fanned nationalism and anti-foreign sentiment, and the danger for American companies is that these types of boycotts could actually affect not just imports, but also the sale of their locally made products. So this is just another tool that China could use in its toolbox to retaliate. For Nightly Business Report, I'm Eunice Yoon in Beijing.
More now on that monthly jobs report that was released first thing this morning. It showed that employers hired fewer workers than expected in March. Non-farm payrolls grew by 103,000, almost double was expected. The unemployment rate held at that 17-year low of 4.1%, with a slight uptick in wages. But as Hampton Pearson reports now, as so often happens, the headline numbers don't tell the whole story.
Weather was a key factor in the job slowdown in March. Late spring snowstorms in the Northeast triggered dramatic downturns in key sectors, including construction, which lost 15,000 workers after adding 65,000 in February. Retail suffered a similar downturn. 4,000 fewer hires last month versus an increase of 47,000 in February. It all combined to produce the lowest monthly headline job growth since the hurricanes last fall.
The jobs number today, it's a little bit like snowfall in April. It's unpleasant, but probably not a harbinger of things to come. So I do think the payroll numbers will improve over the next few months.
The unemployment rate at 4.1% remains at a 17-year low, and wages actually increased, up 0.3% for the month and 2.7% year over year to just under $27 an hour on average.
The question is what types of pay raises they got. The wage number here was decent. If you look at the production and non-supervisory side, throwing out the managers, we continue to have slower wage growth for that. That might be sort of a little bit closer to what your typical worker is than the other series.
Professional and business services led the way in job creation, adding 33,000 workers. Despite concerns about a trade war, including higher steel tariffs, manufacturing was a leading job growth sector with 22,000 new workers finding jobs. And even with downward revisions for January and February, average monthly job gains for the first quarter of this year are above 200,000.
I think the labor market's still quite strong. If you look at the last 3 months, we still are basically getting 200,000 new jobs per month on average, and that probably washes out a lot of the weather effects.
In the coming months, it'll not be the weather, but storm clouds over trade policy that may impact job growth and add another concern for the Fed when it comes to monetary policy. For Nightly Business Report, I'm Hampton Pearson in Washington.
Well, let's bring in Brad McMillan now. He is going to talk more about today's jobs report, the economy, the stock market. We have a lot to talk about here, Brad. You're Chief Investment Officer at Commonwealth Financial Network. Thanks for joining us tonight.
Glad to be here.
First of all, the jobs. Herky-jerky kind of, maybe we attribute it to the winter weather. Or what do you see going on right now?
I think this is really noise. I mean, on the one hand, it was the lowest number in the past 6 months. But on the other hand, in February, we had the strongest number in the past 2.5 years.
Right.
Just as things aren't as good as February, they're not as bad as March. On average, we're actually doing better than we were in 2017, and I'm not worried about that.
The Fed said after their last meeting they could see the unemployment rate dropping maybe to 3.8% by the end of the year. Do you see that as well?
I do. Right now, you're seeing employers desperate for workers. They're going out, they're hiring people. They need to get people just to fill the spaces. So because of that, they're going to be hiring people that maybe they wouldn't like to hire, and that's going to push the unemployment rate down to levels we maybe have never seen before.
And we heard from Chairman Powell today. We've heard from John Williams and some of the others on the Fed. They're talking still about maybe three more rate increases this year. How do you see that?
I think it's at least 3, and I think the bias is for 4 or maybe 5. When you see unemployment actually better than what the Fed would like to see, we're at better than full employment. And when you see inflation and wage growth starting to heat up, and Chair Powell was quite clear about that, they have to act and they have to get ahead of it. And I think that's what I took away from Chair Powell's speech today.
Now, trade, is that a lot of noise as well? I mean, the market seems to act that, the U.S. officials say that these are negotiating tactics that we're witnessing right now with the threat of tariffs. But the market seems to be taking it more real. What do you think?
Well, I think the first time it happened, we indeed saw the market get upset because this was different. But then the negotiating tactics, the market bought into that. And the second time, that also happened. 3 times, it's starting to get a little bit tougher to say this is just a negotiating tactic. And the question here is it 3 strikes, you're out? I don't think so, but we're getting closer to that. I think the market is getting closer to a point where it really is going to react.
Meaning what? Do you see this as an opportunity to invest on those stocks that have been beaten down over fears of tariffs, or do you just stand aside for a while?
I think at this point you need to take a step back. It's not to say that anybody needs to panic. It's certainly not. In fact, right now the market has actually stayed above its long-term trend line. But at the same time, there is a potential, as we heard from Secretary Mnuchin today, that things could get worse. And if that's the case, the markets could certainly be impacted.
Brad, thank you. Have a good weekend.
You too. Thank you.
Brad McMillan with Commonwealth Financial Network joining us tonight. And up next, all the talk of trade may be wreaking havoc on stocks, but imagine being a small business owner caught in the middle between a spat of the superpowers. California's wine industry, for one, has become a target of China's retaliatory tariffs. Now, if the tariffs were actually imposed, it would be a big blow to winemakers in that state because they do ship a lot of wine to the Chinese. Didi Roy is at a winery in Napa Valley that views China as a very big market.
So this is our flagship Cabernet Sauvignon.
Stephanie Honig co-owns Honig Vineyard and Winery in Napa Valley. For the last decade, she's worked hard at growing the winery's business in China.
We go once a year, work with our importer, and meet with people, and education is key.
They sell about 1,000 cases a year to China. Each bottle sells for about $100 there. But now China's announced a 15% tariff on U.S. wine imports. Honig worries that will drive away their Chinese customers.
They're a huge concern. They're a huge concern because we've been working really hard for over 10 years in growing our market and growing our consumer base in China. And this will have an impact on us and our importers and our partnerships.
She's not the only one. China is the fastest growing wine market in the world, according to trade group The Wine Institute. Last year alone, Greater China brought in $210 million worth of wine from the U.S.
It is what we call the first-year bellroom.
David Pearson is the CEO of high-end brand Opus One. He says their relationship with Chinese customers is so critical, the winery even offers tours in Mandarin.
Emerging markets are critical to the health of the larger market, and China is one of the most dynamic emerging markets.
But he isn't as concerned about the tariffs. A bottle of Opus One costs about $600, and many experts say at that price level, customers are willing to pay more for the brand.
I think that it's very fair and not surprising to understand that luxury-priced products are less elastic in terms of the impact of price changes, and the demand for them, I think, will be less impacted.
Stephanie Honig says while the tariffs may cut into Chinese sales in the short term, they'll continue to invest in the relationship for the long run.
You know, keep going, keep building our relationships, keep telling our story, keep showing our wines, and the wines we feel speak for themselves. And Napa Valley will continue to succeed in China. It might take a little longer now, but we will continue to grow.
Experts say countries like Australia and New Zealand may benefit from the tariffs. Wine from those countries don't face the extra tariffs, so Chinese customers may turn to those brands instead. For Nightly Business Report, I'm Aditi Roy, Rutherford, California.
A promising cancer drug fails in a closely watched clinical trial, and that's where we begin tonight's market focus. Biopharma company Incyte said that its immunotherapy treatment used in combination with one of Merck's key cancer drugs did not help stop the progression of a type of skin cancer, and as a result, that study has now been halted. Merck shares fell by 2% on that news to 53.36, and Incyte shares plunged nearly 23% to 64.02. Meanwhile, grocery retailer SuperValu is reportedly exploring a potential sale. Reports say that the company is working with an advisor to consider all of its options, following calls from activist investors. SuperValu shares popped by 9% on that news at $16.75. And Ford is recalling about 350,000 trucks and SUVs, with the automaker saying that a gear shift issue could cause the vehicle to continue to move even after it's put in park. The recall applies to the various vehicles you see here, including its best-selling F-150 pickup truck. Ford said that dealers will inspect and make the necessary repairs. For free shares of the company were down 1.5% today to 11.18. Now to our weekly market monitor, who has a list of names that he says will benefit from a strengthening economy. Now, last time he was with us, that was back in September, he recommended shares of the iShares U.S. Homebuilder ETF, which since then has been up 18%. He recommended the Wisdom Tree Europe ETF, which is up 3% over that time, and shares of Legg Mason, which are up 8%. Mark Lucchini is back with us. He's Chief Investment Strategist at Janney Montgomery Scott. Mark, always good to see you. Thanks for joining us.
Thanks, Bill.
Your premise is that all the noise, all the talk about trade problems, all the worries about Fed raising rates, when all is said and done, you think this economy is just going to continue to get stronger, and you should invest accordingly. Is that the idea?
It is ours, Bill. We think that to be the case. We see, obviously, sturdy economic activity coming into this year. We think the fiscal impulse from corporate and individual tax reform, along with the Budget Act, putting an additional $300 billion into the economy over the next couple of years, is likely to boost economic activity over 2018. Now, I think there's some risk here that this trade tariff skirmish metastasizes into a war. I don't think it's necessarily better than a 50% concern at this juncture, but it's non-trivial nonetheless. So it's a risk that we're monitoring very, very closely, but our base case remains the U.S. economy is in good shape and I think should provide a fertile climate for the stocks that we like at the moment.
And you're recommending 3 ETFs for us tonight. The first one in the financial services area, KCE. Tell us about that.
Sure. Well, all three will be cyclically disposed, meaning to benefit from a stronger demand in the economy. KCE is an ETF that's primarily comprised of asset managers and custodian banks, both of which stand to benefit from better improving financial markets, which we've had and we think we will again. And then secondly, rising short-term interest rates.
This one, you are recommending XAR in aerospace and defense, but interestingly, Boeing is not a major component of this because they do have a problem with the trade issues, don't they?
They do, Bill, deliberately so. I mean, while once again we think trade risks will ultimately recede, nonetheless, if you look at the other aerospace and defense-related ETFs, they have a disproportionate weighting in Boeing. So it's a big bet on what Boeing does directly, one way or the other, trade tariff or not. XAR levels the playing field of its components that comprise the ETF, and we think obviously spending primarily on defense is obviously going in one direction, and that's up from here, not only domestically, but globally.
And finally and quickly, if we can, IGV, a tech ETF primarily on software, right?
It is. Business spending is going up. Businesses spend disproportionately on technology, and within technology, mostly on software. So a software ETF, the Microsofts, the Salesforces, the Oracles.com fits that bill.
Mark, always good to see you. Thanks. Have a great weekend.
Thanks, Bill.
Mark Lucchini with Janney Montgomery Scott. And to read more about Mark's picks, you can head to our website at nbr.com. Coming up, need a quiet place to get some work done? 2 entrepreneurs had the brightest idea to bring privacy to public spaces. We've all been there. You've got a little time to kill, but you can't find a place to charge your phone or jump on a phone call. We're mobile these days, but it seems that our infrastructure doesn't always accommodate that mobility. That's why 2 New York City entrepreneurs got the bright idea to create a modern workspace for people on the go. When Brian Hackathorn found himself between meetings in New York City 5 years ago, he settled into a public space.
Pulled out my computer, was trying to work, and it wasn't productive. Security was ushering people out who were trying to plug into power. People were eating, communicating. So the idea at that time was, we need something new to solve for this problem.
Ironically, it's a problem he helped create. At the time, Hackathorn and his business partner, Jeremy Jennings, were selling office furniture for open spaces, the type of spaces that Hackathorn had been designing since 2001.
I'm thinking we need like the modern day phone booth.
Ah, yes. Remember the phone booth? Jennings instantly shared the vision.
Just that week, I got a text saying I need to jump on a phone call. So my question to you is, where do you go?
Jennings and Hackathorn thought they would try their modern phone booths in places like Central Park.
The problem with Central Park, it's landmarked.
Another problem was the product didn't actually exist, so they designed the Jabberbox themselves, and then pivoted away from public spaces when a New Jersey company, Audible, saw their drawings and wanted to buy them for their open office. So Hackathorn and Jennings worked with a manufacturer to build and install the first 5 Jabberboxes in 2016.
We had just completed our very first installation and had a call, and we're like, this is a perfect place to do it from.
There are now about 200 Jabberboxes in offices as far away as Berlin, Germany, Dublin, Ireland, and London. A single-seat model runs $13,500. The 2-seater is $24,000. Revenues are already close to $2.5 million, and they expect to sell more than 200 Jabberboxes this year.
You're always on the go. You're always in front of a screen. You're being spoken to. You're being asked questions. To have a little time to yourself, to think, to relax, to breathe, it's priceless.
After tweaking them for public spaces, 7 Jabberboxes debuted in Terminal B at New York's LaGuardia Airport in February.
Slide in your chip card. approved. And then we have the ability to unlock the door.
Starting at $10 for 15 minutes, you can plug in and access the encrypted Jabberbox Wi-Fi network in peace and quiet. You can track your flight, even adjust the lighting.
We have also developed a little playful photo booth app where you can go through and actually take photos of yourself.
Ed Backlor is working on the redevelopment of Terminal B at LaGuardia.
Early indications are that it does seem to be very well received. How often do I wind up at a gate or on a conference call as you're about to board? And the challenge is you can't be back at the lounge, you can't find that quiet spot. Now we've brought that quiet spot to the gate.
As Jennings likes to say, Superman may have had a phone booth, but you can have a Jabberbox.
This isn't really a phone. This is a supercomputer. This allows you to work where, when, and how you want. So a Jabberbox really isn't a phone booth. It's a work booth.
Just parts together.
And Hackathorn and Jennings expect their Jabberbox to appear in more airports later this year, and you might be seeing them elsewhere: hotels, hospitals, malls, conference sites, and convention centers, even theaters and sports venues, maybe even your own office as well. Before we go, another look at the day on Wall Street. Another big down day. The Dow dropped by 572 points, back below 24,000. The Nasdaq was off by 161. The S&P down 58. All the major averages down more than 2% today, and all three were lower for the week as well. That is Nightly Business Report for tonight. I'm Bill Griffith. Thanks so much for joining us. Have a wonderful weekend. We'll see you again on Monday.